let's jump right into this explainer. Today, we're unpacking a massive point of friction right now in Ghana, the student housing crisis. If you've ever wondered why student rent is so incredibly high, well, we've got some answers. We're looking at a fascinating May 2026 editorial by Dr. Kenneth Appiah-Dankor Hiaman. It really strips away all the emotion to show us the actual raw mechanics at play here.
The author's central argument? It pulls absolutely no punches. He states that when the government threatens to shut down private hostels or cap rents, all while failing to actually provide beds themselves, it's not housing policy. It is, quote, free riding with an enforcement badge. Wow, that's a bold claim, and it perfectly sets the stage for the economic analysis we're about to dive into.
To really unpack this impartially, we've got a clear roadmap. We'll hit enrollment versus accommodation, then look at the real cost of building, dive into the Africa Integras model, and finally wrap up with some structural solutions for the state.
So, let's start with part 1, enrollment versus accommodation, and the statistical root cause of this whole thing.
You've really got to wrap your head around the sheer scale of the gap here. Between 2000 and 2023, public university enrollment absolutely exploded. We're talking over 250% growth. But government-funded dormitory beds? Those grew by less than 40%. Basically, the state created this massive surge in demand, but left it entirely up to the private sector to figure out how to put roofs over all those students' heads.
Which brings us right into Section 2, the real cost of building, where we see that it's actually about economics, not greed.
The economic hurdles here are, frankly, staggering. Just to get a half-acre of land near East Legon, you're looking at 4.5 million cedis. On top of that, construction costs have spiked 40% since just 2022. But here's the real kicker: financing. Bank interest rates are hovering anywhere between 28 and 42%. I mean, imagine trying to borrow 10 million cedis to build a 100-bed facility, all while paying 35% interest. It's those brutal macroeconomic realities that dictate the rent, not just developers wanting more money.
And the editorial points out a super dangerous disconnect here. On one hand, developers literally have to charge high rents just to claw back those massive capital costs. But on the other hand, you have the rent commissioner threatening closures and slapping caps on what they call exploitative rents. Adding the threat of government expropriation to a market that is already this risky, it's a recipe for disaster. Because if investors think their rents might get artificially rolled back, they just won't build. It essentially guarantees that no rational investor is going to step up to build the next desperately needed hostel.
So, how do we fix it? Let's move to Section 3, the Africa Integras model, which offers a surprisingly counterintuitive solution.
$64 million. That massive number represents the financing provided by Africa Integras for a 904-bed housing facility right on the Legon campus back in 2015. It was structured as a public-private partnership, or PPP. And honestly, it represents exactly what purposeful private capital looks like when the conditions are actually right.
It's a textbook example of how a partnership can perfectly divide responsibilities. The state puts up its best asset, the land, which costs them absolutely zero cash up front. Then, the private sector steps in, brings that $64 million, and takes on all the construction risk. The ultimate outcome? Roughly 1,000 subsidized beds get freed up for the students who genuinely need them most. It's a win-win.
And this brings up a fascinating aha moment from the author regarding market segmentation. Think about it like this. When a wealthy student pays, say, 15,000 cedis per semester for premium bed, they aren't stealing a spot from a lower-income student. They are actually moving out of a subsidized bed in a traditional hall, like Commonwealth or Mensa Sarba. That cheaper bed can now go to someone who actually needs it. Forcing high-end hostels to lower their prices just pushes those wealthy students back into the cheap halls, which ironically hurts the poorest students the most.
Okay, moving to our final section, solutions for the state, let's look at a concrete policy roadmap.
If price controls don't work, what does? The editorial lays out a precise 3-step sequence. First, the immediate fix. Unlock that university land for private concessions. Second, the urgent fix. Offer real fiscal relief. We're talking 10-year corporate tax holidays and zero-rated import duties for developers who agree to allocate 30% of their beds at below-market rates. And third, the structural fix. Officially recognize and protect this multi-tiered market system as national policy.
Ultimately, the core takeaway here is that there needs to be a massive mindset shift. The rent control department really needs to stop treating private developers like the enemy. These private operators stepped up to perform a function the state simply couldn't or wouldn't do. Every single hostel threatened with closure is a facility the government has no capacity to replace, and every investor scared off by regulatory risks, that is capital the state literally cannot substitute.
The government spent over 30 years building this crisis by aggressively expanding enrollment without investing in accommodation. They can't just regulate their way out of this. They literally have to build their way out. Which leaves us with this final critical question based on the analysis. Will Ghana choose partnership in construction or regulation and stagnation? What do you think?